August 7, 1992. Real Estate Capital Basics, Hybrid Loans Pros and Cons. Hybrid funding loans based on a combination of debt and equity are underwritten based on the following overall parameters. Property types. Property preferences continuously change based on supply and demand factors, investor preferences, local and national market perspectives, technological factors, financing availability, and a multitude of other variables. New developments, institutional-grade conventional property types, multifamily, industrial, office and retail, preferred, followed by lodging, healthcare and recreational properties as ancillary uses within a mixed-use venture. Existing properties acceptable, providing ample yield upside justifies higher leverage and equity conversion. Net lease, all property types acceptable for credit-tenant facilities. Multifamily, apartments, including affordable, market and luxury rentals. To a lesser extent student and senior housing projects are considered. Conventional commercial properties, industrial, warehouse, manufacturing, flex/tech, self-storage, office, medical, and retail, mall, community, neighborhood and specialty centers, mixed-use and parking structures. Non-conventional, limited appetite for hospitality, healthcare and recreational, golf course, water park. Only prime quality developable land. Dollar size/funding sources profile. Under $5 million governed by local players with hands-on management including families, contractors and adjacent property owners seeking more real estate diversification. Mostly casual or part-time investing with limited financial sophistication. $5 million to $30 million attract professional local and regional players having market presence in the general area. More sophisticated financial analysis and full-time resources dedicated to operations. Funds usually syndicated, often including wealthier individuals. $30 million or more attracts institutional investors hiring professional management. Larger publicly traded and private investment syndicates emerge as common players. Financial institutions and funding sources legally and financially chartered to fund debt and equity, typically excludes banks. Life companies, pension funds, syndicated debt fund and endowments with sophisticated staff or advisors proficient with hybrid capital underwriting. Investors range from individuals looking for real estate investments to institutional investors who routinely take equity positions in real estate ventures. Select institutions purchase for cash, supplying 100% of the necessary equity, while others leverage their purchases, using debt funds from other sources. Insurance companies are among the long-standing and reliable funding sources. As supplies tighten, life companies and other institutional players are less willing to accept fixed yields on the funds, favoring hybrid formats. Term. Various partners may require different ownership cycles and related buy-sell provisions. Formulated to include profit distribution timing including regular income, for example, ordinary income for merchant builder, and capital appreciation, for example, longer term. Equal to project ownership life cycle, typically 5 years or more for strategic investing and longer-term holding periods. Short term, 3 years or less targeted for value creation. Term is suitable for new construction, rehab and value speculation. Investors include developers, speculators and short-term public or privately syndicated funds. Medium term, 3 to 5 years targeted for more patient value speculation and longer redevelopment cycles, for example, rehab based on tenant rollovers with medium-term lease expirations. Investors include developers, hedge funds, syndications and other tactical players. Long-term, 5 years or more patient value speculation and longer redevelopment cycles, for example, rehab based on tenant rollovers with medium-term lease expirations. Investors include life companies, pension funds, endowments, owner-occupants, REITs and other strategic funds. Shorter term targeted towards value creation and quicker capital appreciation opportunities. Holding periods targeted towards owning real estate as an investment instead of ongoing development/construction as in the case of builders. Planned holding timelines often change in light of dramatic changes in financial markets including unexpected price increases or decreases. With convertible debt, conversion option term intervals enforceable upon reaching project lifecycle benchmarks including physical completion, leasing thresholds, cash flow stabilization or other value creation events, typically starting from the 3rd year. Term may be prematurely shortened by substantial capital market changes unrelated to the project, including extremely attractive sales prices and low interest rates, or on the opposite end, soft market conditions. 6 to 12 months extra term often built into the timeline as safety margins for converting, extending, refinancing or selling the venture within close proximity to the planned maturity date. Either parties, the funding source or sponsorship, may initiate term expirations, extensions and conversions, depending upon venture provisions. Land leases greater than or equal to leasehold debt, possible term of 30 to 50 or more. Leverage. Typical hybrid ventures for Class A and B properties are structured with full proceeds. Funding sources frequently contribute well over 90% of the total capital for a project, the developer contributing the remaining 10% or less of equity. Equity credits usually include assets contributed at market value instead of cost, common with land contributions, if owned by the developer and entitled over a longer period of time of say, 2 years or more. Other credits include actual monies spent prior to ventures such as developers' out-of-pocket expenses, developer fees and front-end profits deferred. Financial enhancements including personal guarantees, additional collateral, letters of credit and holdbacks often required as performance covenants in determining funding amounts, shortfalls and earnouts. Complicated, highly structured transaction often feature 3 or more layers of funding including primary equity/debt, mezzanine funds/preferred equity and developer cash. Depending upon market liquidity, seller financing bridges and equity gap requirements. Investors with strong financial statements and ownership experience often obtain more seller and primary lender leverage. Institutional players with longer-term holding cycles typically invest 35% or more. Some major pension funds and other tax-free investors may purchase assets on an all-cash basis, depending upon the cost of leverage. Credit tenants, recourse and other guarantees raise funding limits, depending upon cash flow quality, term and other such variables. Loan-to-cost overrides loan-to-value ratio as full project costs limit maximum funding ceilings in hybrid structures. During difficult economic cycles, funding sources will contribute full project costs and developers contribute minor hybrid funds, but receive fees and recover costs. Availability of financing and pricing influence equity contribution decisions, even when ample funds exist. When funding markets are conservative, more equity is required, and the opposite holds true when underwriting standards are liberal. Value creation investors seeking highest yields based on maximum leverage target 20% or less equity. Defensive investors prefer low leverage, below 65%, and correspondingly lower returns. Buy-sell provisions bound by debt-equity investment proportions, equity ownership or market value calculations. Profit-sharing formulas. Higher equity ownership ratios exchange for lower preferred returns. Ownership split and net cash flow profit and loss distribution ratios not necessarily equal, depending upon equity contribution, project control and other factors. Non-taxable funding sources trade tax benefits for larger cash flow distribution and reversion share. Annual cash flow profits, also known as bonus, kickers, premiums, participations, splits and surplus annual cash flow. Reversions take form of refinancing, sale, partial sale, or any other form of profit distribution based upon a capital event. In most instances, a one-time event, the venture is dissolved. Reversions not necessarily dissolutions, as partners may continue the venture although at revised profit-sharing levels. Reversions activated when refinancing, sale or other capital event occurs with remaining principal loan balance retired, followed by preferred equity and net distributable profits. Annual cash flow profit shortfalls recaptured in reversion based on various formulas such as preferred return recapture, for example, waterfalls, generated for providing main funding partner additional yield protection during lower return phase. Developers typically share disproportionately higher profits above waterfall levels. Cash flow participation formula is usually based on effective gross income, net operating income, or cash flow after regular debt service payments. Lower cash flow participation exchange for higher coupon rate. Lower equity participation and cash flow percentages proportional to higher coupon rates. Participations below 50% reserved for lower leverage, premium cash flow, substantial pre-leasing, developer guarantees and other financial enhancements, letters of credit. The closer the participation is to gross income, The lower the participation percentage and the lesser the risk to the lender. Gross income participations typically 3% to 15% or more. Bad debt and vacancy allowances included. Net operating income participations offer highest percentages, typically 25 to 50% or more. Blended cash flow participation including preferred pay rate generally translated 50% to 85% of cash flow and or conversion, depending upon yield requirements and leverage. On rare occasions, cash flow participations foregone such as raw land purchases that have been value enhanced by entitlement and site improvements, sewer and water. Reversion and refinancing profits blended with cash flow profit sharing for calculating overall yields. Equate to unpaid preferred funding amount, for example, loan balance, plus appraised value of developer's equity. Reversion profit formulas include minimum waterfall generated yields with premiums, predetermined price, fixed percentage of net profits and custom formulas linked tied to various market indexes. Should funding source be a non-taxable entity, tax savings to developer often negotiate more attractive yields. Overall yields. Overall yields blend annual cash flow, priority and surplus, and reversion yields. Hybrid fundings based on dynamic underwriting relying upon discounted cash flow and other methods or measuring yields over an extended time frame. Net present value and internal rate of return are the most common calculation formats based on discounted cash flow analysis. Alternatively, payback period used, usually without discounting. Debt and equity yields often bifurcated, depending upon layered funding source. Overall yields normally at 50 to 400 basis points over traditional fixed rates debt for conventional properties. The cost of financing is above the standard and leveraged acquisitions and more comparable to value creation yields, so leveraged yields will be greater than leveraged yields. Unleveraged, discounted cash flow yields, IRR and NPV, similar to equity-oriented investments including joint ventures. Overall yields include all cash flow components such as preferred pay rates, additional cash flow participations and reversion profits. Typically 300 to 500 basis points above conventional debt vehicles. Higher risk projects offer yields often reaching 700 basis points or more. 50% splits or more of the cash flows and reversion value common. Current yields. Static analysis measure applicable for sizing an investment at any given point in time. Not a substitute for overall yields which are more accurate. Not available for projects under construction and stabilization. Instead, yields can be incorporated into project budgets as interest carry reserves. Most commonly distributed on an annual cash flow disbursements. Current yields often distributed in pieces based on priority and subordinate levels of cash flow. Below market cash flow yield terms often exchange for larger ownership share, while higher leverage creates the opposite effect. Priority cash flows represent the lowest risk and most senior position of hybrid funding cash flow distribution, and subsequent yields, often structured as primary annual returns in the form of debt, convertible debt, land sales/leaseback and preferred equity. Priority cash flows and corresponding yields alternatively identified as base, coupon, minimum, pay or preferred rates based on funding source contributions. Priority cash flows normally dispersed on a pari passu basis with funding sources and developers receiving yields based on direct equity investments. Priority returns similar to or, slightly below, comparable fixed-rate debt and preferred/converted equity. Subordinate cash flows represent any additional funds available after distributions of preferred cash flows. Subordinate cash flows offer disproportionate profit allocations with higher splits to developers as performance incentives. Combined cash flow based on unleveraged and leveraged yields substantially overlap due to varying investor and leverage expectations. Greater than or equal to mortgage constant versus mortgage rate is in the case of capitalization rates for appropriate property type. Intentionally lower yields indicate more reliance on reversion. If yields are below mortgage constant, static cash flow analysis inapplicable as investors expect substantial cash flow and reversion appreciation at later within the ownership cycle. Dynamics analysis required. Historically, total current yields, using capitalization rates, hover in the mid to high single-digit range for highest quality conventional properties. Unleveraged current yields, cash on cash, 300 to 500 basis points over comparable term mortgage rates for Class A multifamily, net lease and conventional properties, 500 to 700 basis points for Class B properties. Non-conventional properties are at 400 to 600 basis points for Class A and 600 to 800 basis points or more for Class B properties. Leveraged current yields, 400 to 800 basis points over comparable term mortgage rates for Class A multifamily, net lease and conventional properties, 500 to 1,000 basis points for Class B properties. For non-conventional properties, pricing is 600 to 1,200 basis points over comparable term mortgage rates for Class A, 1,000 basis points or more for Class B properties. 50 basis points or more over return on cost yield, stabilized net operating income divided by total project cost, for new construction ventures and above base rate conventional mortgage interest rates for Class A assets. Wide variation of capitalization rates within various sectors and locations. Major market CBD and urban infill mixed use, parking, office and retail along with newer industrial distribution properties reflect the lower end cap rate range. Other conventional properties in secondary markets trade as much as 300 basis points higher. Multifamily, current the most desirable of all property types, trading on the lower end of the capitalization rate range, often at or below mortgage rates due to income growth potential and demand. Affordable and luxury apartments trade on the lower end of the range and student housing on the higher end due to management intensiveness. Cap rates often lower than other property types as a result of agency lending programs, FHA/HUD, Freddie Mac and FNMA, priced below overall conventional market debt. Trading range starts at about 50 basis points below conventional mortgage rates for Class A, core, properties. Older, Class B, core plus, properties in secondary locations trade at premiums of 100 to 200 basis points more. Net lease, trading at lowest hybrid rate spreads and directly tied to credit-tenant lease quality and term, and physical quality, age and other normal pricing determinants are subordinate to cash flow characteristics. Shorter-term leases of 10 years or less trade at premiums of 100 to 200 basis points or more. Hybrid funding less attractive for such properties as minimum yields prevail, often favoring a straight equity venture instead. Non-conventional, 100 basis points or more above conventional mortgage rates for Class A properties of the same property type. Dramatic pricing variations commonly occur within this subsector of property types, as much as 700 basis points, in some cases such as recreational and management-intensive healthcare. Most to-be-built properties require at least 50 to 200 basis points premiums for calculating stabilized capitalization rates to cover uncertainty, cash flow quality, pre-leasing, and property type differences. Preferred pay rates/yields, for example, participation loan coupon rate, land rent, 0 to 300 basis points below conventional fixed-rate mortgages, excluding any bonus cash flows, reversion and waterfall yields. Subordinated lien hybrid funds at least 300 to 500 points higher than preferred pay rates. Pricing exceptions apply for unique trophy properties in most categories. Payment schedule. Interest-only payments, similar to most types of shorter-term permanent mortgages formats, may be underwritten to 20 to 30-year amortization schedule with conventional fundings, up to 40 years with agency for apartments. Underwritten amortization for stress test analysis only, as new and redeveloped projects seldom offer enough cash flow to carry amortization in early years of investment. Credit-tenant and special-purpose amortization schedules adjusted for cash flow term and operating risk. Lower leverage, 50% or less, and shorter-term loans justify interest-only format due to minimal principal paydown timeline or funding exposure risk. Payment schedule underwriting not necessarily enforced. Instead, may use only for loan sizing stress test calculations which include 20 to 30-year amortization. Customized to income stream characteristics. Adjustable to cash flow fluctuations with variable, graduated or other formats with varying amortization and interest-only formats. Debt service coverage. Less relevant than with conventional financing as investors typically create value with hybrid fundings. In the process of stabilization payments tailored to improving economics. Apply to preferred pay rates. Coverage calculations supersede equity returns, excluding any supplementary interest payments, for example, land rent, as well. Break-even or negative coverage typically expected during early months of stabilization. 100 to 130% of annual debt service, depending upon project stabilization timeline. Upon stabilization similar to permanent, fixed-rate loans, below 120% for credit tenants, 120% or more for multi-tenant, conventional properties, 130% or more for non-conventional properties. If conversion options available, slightly lower coverage allowed. Long-term lease coverage more restrictive on coverage covenants than those with frequent cash flow increases such as apartments. Debt service calculations typically stress test underwritten to include amortization, even if funding is based on interest-only payments. Leverage restrictions may override debt service coverage limits, especially during lower interest rate cycles. Sufficient financial guarantees and other credit enhancements override debt service coverage restrictions. Tiered coverage with credit-tenant income requiring the least amount of cushion. Prepayment premiums. Locked out during project construction and value creation, including land lease term. Very restrictive and based on complete recapture of principal and equity profits using sophisticated discounted cash flow modeling or simpler payback formulas. Specific waterfall price inclusive of principal recapture and minimum equity yield substituted in lieu of yield recapture calculations. Funding period. Forward funding available for periods up to 36 months, matching construction and stabilization horizons. Often linked to land takedown timelines, permanent debt triggers, etc. Immediate funding less desirable as sufficient overall yields rarely available for stabilized projects. Similar to joint ventures, including staged fundings and forward commitments of 12 to 24 months or more. Financing fees. Market-driven. During highly competitive funding markets, fees may only account for servicing credits on loan payments. Base funding -1% or less for larger deals of $25 million for conventional properties and 1% typical for loans below such levels for conventional ventures. Equity funding -1% to 5%, depending upon property type, size and transaction complexity. Blended fees, base and equity funding, computed using combined funding typically 2% to 3%. Repeat client relationships more cost competitive as less underwriting is required. Reduced fees apply for multiple transactions based on a universal cookie-cutter funding models.